on Friday's session, a lot of voices said that what the resolution or what the Supreme Court verdict on SR means is a reiteration of a very large reform like the IBC, and that should please foreign institutional investors. Let's get in Mark Matthews, Head of Research at Asia at Bank Julius Baer, to talk about that and, of course, the other things surrounding India as well. Mark, so good having you as always. Thanks for taking the time out. This is Neeraj here. Good morning. If you've had a chance to look at the Supreme Court verdict and what that serves as a signaling point, because it was a big resolution which was stuck for a number of years now, getting cleared with a thumping verdict from the Supreme Court.
Well, I agree with you, Neeraj. I think it was a landmark decision because the whole bankruptcy court process, and by the way, the bankruptcy court was definitely one of the hallmarks of reform in the first Modi administration. It seemed to be stalled, as you rightly put. And so, getting one of the largest NPAs resolved and creditors paid off, and now these two very large steel entities will be combined, I think is a great positive.
I'm just wondering, Mark, what does this signal not just from a perspective of a steel company coming in, but from a perspective of lenders getting the money back, a foreign investor, a large foreign investor, Indian by origin, but otherwise a foreign company, finally seeing the years of their efforts getting fructification? Do you think this is a potential to please investors, or are there enough and more other factors that will play a part out here?
Yeah, I think it is absolutely pleasing. The idea that secured and unsecured creditors should be treated equally is at odds with the markets. I mean, if you are an unsecured creditor, you're clearly taking bigger risk, and so I'm very glad that the Supreme Court sided with the COC and said that secured creditors first. And I think it bodes very well for the banks as well, because clearly they're the ones that particularly the banks that lend to the corporate sector, have been saddled with these large NPAs. So hopefully it'll speed up the resolution of other ones and aid in the recapitalization of the banking sector, which in my humble opinion is the big thing that's been keeping India back.
What kind of a message, good morning, Mark, Devinaya, what kind of a message does this give out to foreign investors, with regards to the climate in India, and not just this verdict as such, but the fact that, we've been talking a whole lot about, and the finance minister has been laying stress on, India's position in the ease of doing business list. So, we're trying to make sure that we make this the ecosystem such that for foreign institutional investors, not just in the equity markets, but who want to start investing in businesses, the climate is more accommodative.
Well, I think it's very helpful in that regard indeed. This is not a small asset. I think Arcelor, just looking at my notes here, is going to pay something like $6 billion for it. So it's a very major transaction. And the fact that it can be, finally finished bodes well for all of India. I don't know how to put it otherwise.
All right. While we're talking about this and how this stacks up in terms of, the domestic mood as well as the competition that it creates from a big behemoth like ArcelorMittal coming into India, into the metal space. But just, while we've been talking about this, is also get your view on the overall mood of the market right now, with some more optimism with regards to trade talks and how all of that shapes up and pans out with regards to the investment climate.
Well, the trade talks do appear like they are finally going to go somewhere. So we had comments from the Chinese over the weekend through their state media, and we also had comments on Thursday and Friday from the Americans, specifically the Commerce Secretary and the White House Economic Advisor. But what I would say is I don't expect the markets to take a major move up on the back of this simply because the deal is being spread out in phases, probably 3. And the phase that we're looking at now, obviously being the first one, phase 1, is the simplest one. Probably what you will see is the U.S. Will agree to not go ahead and increase the tariffs that had been scheduled for December 15. There's also a probability they could take back some of the existing tariffs. That's what the Chinese have been asking for. But the much more important stuff needs to come up in phase 2, perhaps even a phase 3. The real nitty-gritty of how they're going to rectify the trade imbalance, and China will respect intellectual property protocols, etc. Those are more difficult to achieve, and I think the market is already looking toward that phase 2. So, I mean, it's good news, but with the Shanghai market and the S&P both up about 25% year to date, I don't think that, let's put it this way, they didn't collapse because people expected no deal. Therefore, I really don't see them going much higher on the back of it.
Okay. While there is some amount of optimism, the key question is that the full impact of the trade talk, the trade issues have not yet played out with regards to the numbers that we are seeing coming out of China. If the first phase doesn't go through, for whatever reason it might be, though there is optimism that it will go through, if it doesn't, then the full impact of that will happen in the next year. I think more than 20% is what some analysts in the street have been talking about, which could be an impact for China. How does that play out in the negative situation then?
I really don't think the Chinese economy is in bad shape. It's true the October data was, on the whole, softer than the September data, but only marginally. None of the numbers were very, very weak. And so I think the government will continue to kind of massage at the sidelines the economy. For example, they did a reserve requirement rate cut today, and they injected some money into the financial system through the medium-term lending facility that they have. But nothing really big. I don't think it needs anything big. I think, now they're indicating that next year's growth will be below 6%. I think 5.8 is the number that they've suggested. I also feel that we shouldn't really panic that much. I mean, for a $14 trillion economy to be growing at 5.8% is still very, very big.
Yeah, well, it is. Mark, if I can shift the focus a bit back towards the domestic moves that have happened in India. Now, a lot of people, I would want you to weigh in on this. A lot of people correlate the Indian tax cut to what Donald Trump did or what the US did a year back, and the resultant outperformance in the US markets, and then try and say that India could probably have a similar thing. And there is no way to either affirm that or contradict that because there will be a number of factors which went behind US and not just the tax cuts as well. How do you weigh in the market moving impact of the corporate tax cut rate in India from a next 3-quarter perspective?
I think it will be broadly a positive. Right now, the numbers are all over the place because different companies are taking advantage of the tax cut to do different things. But I think it will add a few percentage points onto EPS growth in the coming quarters. And as much as it does increase the fiscal deficit, I would look at it as a positive. Because the major thing, to come back to what I said earlier, that I think is holding India back is the private sector is simply not investing, and that has a whole follow-through effect on the rest of the economy. And ultimately, the reason for this, I think, is the squeeze in the credit system, and the fact that because the big state banks are still beleaguered with a lot of non-performing assets, and now we've had this non-bank financial system blow up. There isn't enough credit. So in the absence of that, I think it is good to provide some relief to the corporate sector through tax cuts. But is it really going to lead to a sustainable re-rating of India? No, I think for that to happen, you have to have the economy come back, not just the bottom line through lower taxes.
Actually, that was going to be my next question, but you answered that. So I don't think you believe that if the economy, which is going through a patchy scene right now, continues to remain subdued, then a headline change in the bottom line for the Nifty 50 companies or the higher weightage companies will lead the markets higher. You don't believe that?
Not really, no. The other point to make is that the Nifty is already much closer to the NASDAQ valuation-wise than it is to, say, China. It's on about 20 times earnings. NASDAQ is 25 and China's around 10. So it isn't a cheap market. There are many pockets of cheapness in India, and just coming back to the reform, and we talked about the decision of the Supreme Court to side with the COC, but I would also point out the privatizations will help to solidify corporate India, and those seem to be continuing as well. And the PSUs as an aggregate trade on around 7.5 times, and they have a 4% dividend yield. So I'd be looking at that space, for example.
Mark, the first time this government, took the helm, at that time, while India's weightage in the global MSCI equity index was about 9-odd%, the kind of inflows that came into India was at a much higher rate. So it went up all the way to about 14-15% from, the standing weightage of 9%. Right now, we're somewhere at par, just about 8.5 to 9%. So we're standard weightage right now, not in excess. But there is that headroom that could be filled in by the FIs if there is something meaningful that comes about. Now that we have the government in place with a stronger mandate, do you see that even though the initial disruptions in the form of whatever announcements have come in could be made out to be stronger foundations for the upcoming growth cycle for India, and therefore that headroom that's there for FIs to come in is much stronger now?
Well, as much as India is obviously its own very important country, economy, market, it is still part of this cluster that is called emerging markets, and that cluster has been largely ignored by foreign investors over the last 8 years because of dollar strength. And dollar strength is a massive headwind to the emerging market asset class. I've never really been able to figure out why. I understand why people are worried. They don't want to lose money in the currency. So they think, oh, if I'm buying Indian stocks and the rupee goes down, that's bad. But usually the capital gains are more than enough to compensate for the fall in the currency. It's just the way it is, and I therefore think what actually kind of excites me actually over the next decade, because every decade is different, that I do think that at some point, and I'm not saying it's tomorrow, the leadership will move away from the U.S. market, as hard as it is for us to believe that today, because we're so anchored in believing the only place to be is the S&P 500. But at some point over the next, I would say, year, there will be a transition, and I think emerging markets will be a beneficiary. And at that point, I think you'll see a much larger portion of inflows into India. But the signal, I think, will be in the U.S. dollar, and we have to start to see the U.S. dollar weaken before that happens.